Welcome back to Wealth Dynasty. We have a little format change for this section or this subsection of our episodes. These are just little financial snacks, little bite-sized financial educational definitions, or something that's just a really quick educational idea in just a minute or two. So without further ado, I would be asking you questions, and if you think of everything, you ask me questions. So we'll kind of go back and forth on that.
Okay, perfect.
Yeah. So what is life insurance? The most basic way to explain life insurance. What's life insurance?
Life insurance is, at the most basic level, a contract between an individual and an insurance company that promises to pay a certain amount of money if a person dies prematurely or dies at any time, depending on the contract.
Perfect. And so somebody pays for that, and the company has some in the contract that they will pay out a certain amount upon that person's demise.
Correct.
What is term life insurance?
Term life insurance is a life insurance contract for a specified amount of time. It could be 1 year, 5 years, 10 years, 15, 20, 25, 30 years. And if you die during that period of time, the company's going to pay out a claim.
What are the advantages and disadvantages?
The advantage, of course, is it's low cost, very little money out of pocket. The disadvantage, of course, is it got 98% chance of living beyond the term.
So protect you while you're at most risk.
While you're highest risk.
And if you don't have, obviously, the budget for something.
Correct.
What is permanent life insurance?
Permanent life insurance, again, is a contract between an individual or a company and the life insurance company that promises to pay a claim upon the demise of somebody whenever they may pass away. The concept is that the policy will be there whatever they may die, whether it be after the first premium is paid or 75 years from now.
So it's permanent coverage, and what are the advantages and disadvantages there?
Okay, the advantage, of course, is it's going to pay a claim. You don't have to worry that it's going to run out. The disadvantage, of course, compared to term insurance, is more expensive. Obviously, it's got to be more expensive because there is going to be a claim.
Yes.
You got a 100% chance of dying during that period of time.
Okay.
As opposed to 98% chance of outliving it.
Yes.
Okay, so that's the difference. And permanent life insurance typically has cash value accumulation, which huge amounts of flexibility in how that's organized.
What is a PIUL?
Okay, so that P stands for protection. IUL is indexed universal life. So a protection type indexed universal life is a permanent type of policy that's designed to last as long as the person is. And it's a protection based, so it's not accumulation based.
Okay. What's the difference there?
So here's another type of IUL called accumulation IUL, which is much more focused on accumulation, meaning that you're going to accumulate money on a tax favored basis, distribute money on a tax favored basis, and eventually pay a claim.
Okay.
But a PIUL is not going to have a lot of cash value typically. That's mostly structured to provide a death benefit permanent.
And what's the advantages there?
Well, IUL, Index Universal Life, the cash value is attached to indexes. There's typically a variety of indexes each company offers.
Well, what some people may not even know what an index is.
Okay, sorry.
What is
An
that?
index would be like the S&P 500,
Okay.
or the NASDAQ is an index, or there's all sorts of indexes. Russell 2000, a number of indexes. And the insurance companies put together, typically it's all based on the S&P 500 or the European Union Model E. I can't remember what it's called. But it could be a global index as well. But typically the benefit is that the insurance company pegs the cash value growth to the index, but the insurance company takes the risk of the downside, meaning that typically the worst that could happen in a given year, even if the market is negative, is a zero return in the policy. However, they offset that with a cap. So if there's a 30-year 30% year in the S&P 500, you'll probably get about 10.
Okay.
Okay, so there's a cap and a floor.
The floor.
And so it tends to level things out.
So conservative approach.
Yeah.
Okay. Awesome. Accumulation IUL or AIUL. What's an AIUL?
Okay. Accumulation index universal life is typically designed to create cash value accumulation. It becomes a significant asset, a financial asset. Well, all life insurance is a financial asset, but accumulation IUL or whole life, any of those things are really a financial asset, meaning you have a lot of money stored up in the policy that's available to you. It's highly liquid. It grows on a tax deferred basis. It's protected from creditors in many locations, Florida in particular, meaning that if you take withdrawal from that cash value, it's not subject to creditors. The actual cash value is not subject to creditors. The death benefit's not subject to creditors. There's lots of protection. Okay. But it grows on a tax deferred basis, based on an index, and typically does very, very well because the premise comparing that to a regular brokerage account is that in a regular brokerage account, of course, there's taxation. You have dividends that are taxed. When you sell or buy some asset, when you sell some asset, typically there's some sort of a capital gains tax. And there's a cost to the life insurance, but the life insurance is less expensive than the tax. Okay. So compare that to a regular brokerage account, you actually do quite well in the long run because the tax is mitigated. And that's the advantage. So the leverage is get rid of the tax, but you do have the fees for the life insurance.
Yeah. What are capital gains taxes? What are we talking about when we talk about capital gains? That something you can kind of break down real simple?
Yeah, capital gains. I mean, most people understand this to some degree. If you own an asset, say your home, okay, and you live in that home for many years, you sell it later on, hopefully there's a gain in it. Anything that is you sold it for, which is a gain above what you paid for it, is subject to capital gains. Now, there are some limitations. There are some benefits for home ownership. Yeah, that's kind of a bad idea. It's a bad example. Yeah. So let's just use a regular stock, for example. Okay, that's easy. Yeah. You buy Apple stock, whatever the number is, $100 a share, whatever it might be. You hold on to it for a few years, and when you sell it, it's $150 a share. So you paid $100 a share, you sold it for $150. Your $100 is your basis. The $150 is what you sell it for. The $50 difference, that's subject to capital gains. So there's long-term and short-term capital gains. Long-term capital gains are less expensive than short-term capital gains. Short-term capital gains mean that you bought that Apple stock at 100, 6 months later you sold it at 120, and the $20 is subject to short-term capital gains, which is basically the same as ordinary income. Okay. So regular income tax. Yeah. Okay. Capital gains is a little bit lower rate. Long-term capital gains is a little bit lower rate. 24%. It depends on the year. Depends on what the current
administration
has.
And the IRS and everybody.
But typically it's a lower tax rate.
What is long-term care?
So long-term care is care given to people who need help and can't take care of themselves. And typically it's the trigger on long-term care. It's chronic illness. It could be from an accident. It could be from illness, but it's chronic situation. Meaning it's not going to get better probably.
Now, are these insurance policies or are they just?
I'm actually just giving the definition of what long-term care is, not long-term care insurance.
Okay, but yeah.
So long-term care, if someone can't bathe themselves, dress themselves, move themselves around, they can't do the things they normally do when they get up in the morning. They can't brush their teeth. They can't eat breakfast. They can't do it by themselves. Can't go to the bathroom by themselves. They can't hold their stuff. Okay. Any of those things, two of those things happen to somebody, they can get long-term care. Okay. And they can get care. Care is given by any number of people. It could be family members, hired caregivers. It could be home health nurses. It could be inside a adult living facility or a nursing home.
Yeah.
All those things are long-term.
Or a combination, right? Like if you're going
All
through a
combination.
daytime daycare for adults, and then at the nighttime they stay with the family. or
Correct.
something? Right.
Correct. All combination of those things. Long-term care insurance helps pay for that.
Okay.
Long-term care is expensive. No
Insurance.
questions.
Well, no,
The
long-term
actual care
care is
is
expensive.
super expensive. Okay.
Yeah, yeah.
I mean, it's a huge expense that people don't want to think about, but it's there. Typically, it's going to cost, $4,000 to $15,000 a year, a month. Excuse me, a month. A month. Some people spend $30,000 a month on care. Just depends on how much care you want and what level
They need here.
Okay. But it can be quite expensive and definitely could break your bank. Long-term care insurance pays for it. Long-term care insurance is way less expensive than long-term care. That's why you want to do it. You got to get the long-term care insurance while you're healthy.
Yeah. Okay. So you have to get it while you're healthy. Are those always standalone, or can you attach them as riders to a policy, or how do those?
There's all sorts of policies out there, all sorts of different types of contracts. If you're fairly young, you probably want to attach it. You want to attach a long-term care benefit to your life insurance policy, which allows you then to access your life insurance death benefit prior to your demise for long-term care purposes.
Sure.
All right. That's really good for younger people, 30s, 40s, even the 50s. Okay. The great news about that is the money's not lost to your family.
Yeah. It's
going to come back to your family one way or the other, either through care for yourself or through a death benefit to your family. So it's not money lost.
Perfect. Good.
There's other hybrid type policies that have some death benefit, much more focused on the long-term care piece, that have some growth with cost of living and so forth. Those are also very, very good. Those typically are paid for in lump sums or maybe over a 10-year period, something like that. Those are great for people in their 50s, 60s. Once you get in the 70s, 80s, you're better off using some sort of an annuity product that when you turn on the income for the annuity product, when you have a long-term care event, they'll double the amount of income paying for the 4 years.
Yeah.
Okay.
Very nice.
So that's kind of a nice benefit. It's much easier for folks in their 70s and 80s to get that type of coverage as opposed to, those are all good, but I'm not sure what's the best. Depends on your age, depends on your financial situation.
Yeah.
They're all good. They're all valuable. And the problem is the cost of long-term care is so high.
Yeah.
It's super high. It just breaks banks. It breaks families.
Yeah. What is estate planning? If somebody has no idea what we're talking about, when you talk about estate planning, what does that even mean? Like high level overview, what is estate planning?
Your estate is everything you own.
So everybody can have an estate.
Everybody's got an estate.
Okay.
If you got $1 in the bank, you got an estate.
Okay. I own my Walkman, and that's my estate.
That's your estate.
All right. Cool.
Your estate is what you own. And so estate planning is meaning that how am I going to disperse this estate, these funds, this whatever I've got, to whoever I want to give it to upon my demise.
Okay.
Okay. And it could be a charity. It could be your family.
I've heard of people giving it to their cats.
The cats, the dog.
Yeah.
Okay. They set up a trust for the dog.
No, yeah.
Okay. So whatever you want to give it to, that's estate planning. And a lack of estate planning means you die, the court decides where it's going to go. Okay.
Bad idea.
Bad idea. It's a mess.
Yeah.
It's a really unpleasant mess.
Awesome.
Yeah.
Perfect. That's estate planning. What is a will in regards to estate planning? What is a legal will? What does that mean?
So a will is a document. I'm not an attorney, so I probably won't explain this perfectly, but it's a document that just tells you where you want your estate to go.
What your will is for the state.
Right.
The things you own, just like we just talked about.
Right.
Okay.
Right. So in the will, you can name certain items to give to certain people as a addendum to a will.
Okay.
you can name your spouse, you can name your children as beneficiaries, and your will then, just like you indicated, it's what I want to have happen with my stuff.
Perfect.
Okay. Now, a will alone does not avoid probate.
Okay. What is probate, real quick?
So probate means it's got to go to court to be proven, probated, proven
Yep.
that this is where the money's supposed to go.
All right.
That's a mess. That could hold things up.
So will is a basic option, but it's not maybe not always the best option.
It's a basic option.
Okay.
Okay. It's a good option. It's better than having nothing.
Okay.
Okay. Because at least it gives an indication
Yeah.
and of where you want the money to go. Without any indication, then who knows?
Does that have to be notarized or something? If I,
No, actually it doesn't. It could be written down on a piece of paper and signed.
oh,
Okay.
okay.
Yeah, but it's better to have an attorney draw that up
Yeah.
and to have it done properly. Far better. Far better.
How much would that cost for somebody to get a will?
I don't know. I don't want to quote attorney's fees. A couple $1,000s probably.
Yeah, I mean, obviously, and
And
also,
it depends on the estate.
Depends on
Some
the estate,
estates you might spend $100,000 getting everything set up
yeah,
with all the different trusts, all the different structure needed. It can be quite complex, or it can be quite simple.
they would not be using a will in that situation. They'd probably just use
There'd be a will. There'd be also other documents,
some other
as well,
trust structure.
trust structures, all sorts of
Corporate
different things.
structures.
Yeah, that can be used.
Okay. So will, basic document with what you want to happen upon your demise.
And so in estate planning, now the great thing is many of your assets, you can name a beneficiary to directly. Excuse me.
And what is a beneficiary, real quick? So people may not know what a beneficiary is.
Okay. That's the person that's going to receive funds. So a person can have a wife, children, or spouse, or husband, children. They can be beneficiaries. A charity can be a beneficiary. Anybody that they want to name could be a beneficiary.
The person that's going to receive what they're
Correct.
going to go ahead and
So many of your assets you can name beneficiaries. That avoids probate. So life insurance, annuities, your retirement plan, you can name beneficiaries on your brokerage account typically. So all those things can have beneficiaries.
Yeah.
Your bank account can have some beneficiaries. And so something happens, you pass away, then those named beneficiaries can get that money without probate. Okay.
very important.
Yeah. Now, if you have homes or pieces of real estate, you don't really name beneficiaries for real estate. That's better held by a trust or something like that where you can name a beneficiary.
Perfect.
Now, not to say your home. Homes are different, but homes can be a problem because it's a little challenging sometimes. So if you own a home, see an attorney, get that squared away.
Perfect.